If you're currently saving for your first home in Australia, the government is sitting on close to $8,000, it would hand you for free, and almost nobody claims it properly. Quick note before we go further. This is general information about a real Australian tax structure, not personal financial advice. Your own numbers will depend on your income, your fund, and your situation. So this isn't a substitute for advice tailored to you. And no, this isn't a dodgy side hustle or a crypto loophole. It's a standard government-built scheme sitting inside the tax system that most first home buyers either don't know about or get wrong in a way that costs them the whole benefit. It's called the First Home Super Saver Scheme, FHSS for short. It lets you build your house deposit inside superannuation, taxed at a fraction of your normal income tax rate, then pull it back out again when you're ready to buy. Here's the catch. Buyers get so intimidated by the ATO paperwork that they either never start or they trigger a processing delay that can genuinely wreck a settlement date. Get the order of operations wrong, and your deposit can end up sitting behind rules that weren't built for a house purchase timeline at all. Today, we walk through exactly how to claim your share of that $7,650 and exactly what not to trigger along the way.
Picture Dave and Jess, same $90,000 salary, same 32% marginal tax rate, both trying to save $15,000 toward a deposit this year. Dave saves it the normal way, into a high-interest savings account. That $15,000 comes out of his pay after tax already took its cut. So in reality, he's only ever moving around $10,200 into that account, and any interest it earns gets taxed again at his 32% rate. Jess uses FHSS instead. She salary sacrifices that same $15,000 straight into her super before her normal income tax touches it. Inside super, it's only taxed at a flat 15%. That means $12,750 of hers is working toward her deposit from day one. More than $2,000 ahead of Dave on the exact same salary, before either of them has earned a cent of interest. When Jess eventually withdraws it to buy her home, she gets back 85% of what she contributed, plus deemed earnings. Using the ATO's shortfall interest charge rate, currently sitting around 7%, but it's reset every quarter, so check at .gov.au for the live figure before you rely on it. And that withdrawal is taxed at her marginal rate minus a 30% offset, which works out to an effective exit tax of only around 2%. Net result, roughly $7,650 in pure tax savings across the $50,000 lifetime FHSS cap, just by choosing where the same dollars sit while they grow. Here's something a lot of older explainers still get wrong. The old rule used to be brutal. Sign a house contract before you'd requested your FHSS determination, and you were locked out of the scheme entirely, no exceptions. That rule changed. Since September 2024, you're safe as long as you request your determination before settlement, not before you sign. But there's still a real trap hiding in the timeline. The path from determination to release request, to fund transfer, to the ATO actually processing it, to the money landing in your bank account can take roughly 15 to 25 business days. Call it 4 to 6 weeks in the real world. Start that process the week before you need the cash, and you can blow your settlement date. The fix is simple. Apply 6 to 8 weeks before you'll actually need the money, not the week you need it. 2 gotchas catch more first home buyers than anything else in this scheme. Gotcha number 1, the notice of intent trap. If you're making personal, after-tax contributions rather than salary sacrifice, you have to lodge a notice of intent to claim a deduction with your super fund before you request your ATO determination. Get that order backwards, and the ATO treats your savings as ordinary non-concessional contributions, meaning you lose the entire tax benefit you thought you'd banked. Gotcha number 2, the Payslip Illusion. MyGov often pre-fills your contribution history straight from your employer's payroll data, but the ATO only counts a contribution on the date it actually lands inside your super fund, not the date it left your payslip. A contribution from your June payslip can easily not arrive in your fund until July. Don't trust the payslip date. Check your actual super fund transaction history before you rely on any number. Reasonable question. What if you use FHSS and then your plans change? Is that deposit trapped in super until you're 60? No. Once your money's released, you get a 12-month window to sign a contract, with one automatic 12-month extension available, 24 months total. If a house purchase still doesn't happen in that window, you've got two honest options. Recontribute the net amount back into super with no penalty, where it simply keeps building as retirement wealth. Or keep the cash outside super, pay a flat 20% FHSS penalty tax on it, and walk away with full access. The tax benefit reversed, but the money's yours. Here's exactly what to do tonight. First, confirm your own super fund actually allows FHSS releases. Almost every major fund does, but it takes 30 seconds to check. Second, check your concessional cap for this financial year. It's $32,500 from the 1st of July 2026, and your employer's compulsory 12% already counts toward it. On an $85,000 salary, that's roughly $10,200 of employer contributions already used, leaving you around $22,300 of headroom to salary sacrifice into. Third, if that feels like too much at once, start small. Even $100 a week redirected into super instead of a savings account can build an extra $1,500 or so in tax savings in year one alone. Your deposit is already the hardest part of buying a home in this country. Don't leave $7,650 sitting with the tax office when it's meant to be sitting in your bank account. Make sure you subscribe, and let's get sorted.